You ever look at a stock chart and just your eyes glaze over? It looks like a bunch of crazy squiggles, right? Well, stick with me because by the end of this, we're going to make you fluent. We're going to turn that chaos into a story you can actually understand. And that's really the most important thing to get right off the bat. This isn't some secret code for Wall Street wizards. Nope, it's a skill. And just like shooting a basketball or learning an instrument, you get better the more you do it. So let's get our first practice session in right now. All right, so here's the game plan. We're going to cover why charts even tell a story in the first place. Then we'll look at the parts of a stock chart. After that, we'll dive into volume and trends, give you your first set of tools, and wrap up with some common beginner mistakes you'll definitely want to avoid. Okay, let's kick things off. Section 1. Why do these charts even matter? Well, think of them as the language of the market. They take all this messy data and turn it into something you can actually make decisions with. I absolutely love this comparison. A stock chart is basically an EKG for the market's heart. It's showing you the pulse, right? The constant push and pull between buyers, the bulls, and sellers, the bears. It's like a visual health report for a stock, minute by minute, day by day. So why should you care? Well, charts help you answer the big questions, like is now a good time to get in, or are the sellers starting to win the battle? And maybe most importantly, where do I put my safety net, my stop loss, so I don't get wiped out? It's all about trading with a plan instead of just, throwing a dart at a board. All right, time to get into the nitty-gritty. Let's look at the actual building blocks of a chart. We're going to start with the one you'll see pretty much everywhere. And that is the candlestick chart. There's a reason traders love this thing. It's because every single one of those little candles is packed with information. We're talking 4 key data points: the open, the high, the low, and the close price for whatever time frame you're looking at. See? Every single candle tells a mini story of a trading session. That thick part, that's called the body. Shows you where the price opened and where it closed. The skinny lines sticking out, those are the wicks, and they show the absolute highest and lowest prices the stock hit. And the color, that's your cheat sheet for sentiment. Green means the price closed higher than it opened. That's bullish. Red means it closed lower. That's bearish. Simple, right? Now, you've probably also seen a simple line chart, right? It's great for just seeing the big long-term trend. But the candlestick chart, that's where the drama is. It shows you the story inside the trend, all the volatility and that daily fight between the bulls and bears. Okay, so we can now read a single day's story. Let's zoom out a bit. Because look, knowing the price is one thing, but knowing the force driving that price, that's where the real magic happens. Think about it. A stock goes up, but was that a powerful surge with tons of people buying in? Or was it just kind of drifting up on fumes with nobody really paying attention? How do you tell the difference? The answer is volume. I like to call volume the market's truth serum. It tells you exactly how many shares were traded. It shows you the conviction. So, a big price jump on huge volume, that's a strong signal. But that same price jump on tiny volume, that could be a trap. So here are 4 basic patterns that are a great place to start. If a stock is going up and the volume is high, that's bullish. Lots of people are excited. But if it's going up and volume is super low, that could mean the move is running out of steam. It's all about using volume to confirm what you're seeing in the price. And all this stuff, the price, the volume, it helps us spot the overall trend. An uptrend isn't just a random line going up. It's a very specific pattern, a series of higher highs and higher lows. Think of it like climbing a staircase. And a downtrend? It's the opposite, a staircase going down with lower highs and lower lows. Being able to see this structure is like step 1 of chart analysis. All right, you've got the fundamentals. You're ready for level 2. Let's add a couple of simple, but honestly, super powerful tools to your chart. Think of these as special lenses. First up, moving averages. The idea here is simple. They smooth out all the choppy day-to-day price action, the waves, so you can see the real underlying trend, the tide. The 2 you'll hear about most are the 50-day and the 200-day. All they are is the average closing price over the last 50 or 200 days. The 50 gives you the medium-term picture, and the 200 gives you the big, long-term one. And let me tell you, that 200-day moving average, it's a big deal. Seriously, the big players on Wall Street, they watch this line like a hawk. For a lot of them, it's a simple rule. If the stock price is above the 200-day, its long-term health is good. If it's below, not so much. It's that simple, but man, is it powerful. Okay, now here's where it gets really interesting. When these two lines interact, they can signal some major shifts. First, there's the golden cross. Sounds epic, right? That's when the shorter-term 50-day line crosses above the longer-term 200-day line. This is a classic bullish signal that a lot of traders see as the start of a new major uptrend. And then you have the opposite, the death cross. Yeah, the name says it all. This is when that 50-day line crosses below the 200-day. As you can probably guess, this is a big red flag, a major bearish signal that could be warning of a serious downturn. Okay, one last tool for your starting toolkit, the RSI, or Relative Strength Index. Think of this as a speedometer for the stock price. It tells you if a move has gone too far, too fast. If the reading gets above 70, it's considered overbought, like a rubber band that's been stretched too far and might snap back. Below 30, it's oversold and might be due for a bounce. All right, let's bring it all home. We've got the knowledge. Now let's talk about wisdom. We're going to go over the most common mistakes beginners make so you can sidestep those traps right from the start. Okay, let's list them out. Number 1, don't rely on just one indicator. There are no magic bullets here. 2, don't forget to check the volume. Remember, it's the truth serum. 3, make sure you zoom out and look at the bigger picture. 4, don't clutter your chart with a million tools. It just leads to confusion. And last, but honestly, this should be first, always manage your risk. So what's the big takeaway from all this? It's that you need to think like a detective. You wouldn't solve a crime based on one single clue, right? Same thing here. You're looking for confirmation. You use the price, the volume, the trends, the indicators. You put them all together to build a strong case for your trade. And really, that's the whole point. Learning to read charts isn't about getting a crystal ball to predict the future. It's about getting a clear window into a stock's past and understanding the psychology of the market. It empowers you to stop guessing and start asking much smarter questions. So now that you have the tools, what story are you going to look for first?
Don't forget to subscribe to the channel, like the video, and click on the bell icon to turn on notifications.